Welcome to the weekly update, where I'll go over the action in the market for the week of July 14th through the 18th, and then we'll see how things look for the week of July 21st through the 25th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, looking positive. At least in Friday's session, we set a new intraday all-time high with the S&P, but not a new closing all-time high. And we're looking a little overextended on the daily side. We're looking tired with a lot of our charts. We're just kind of chopping along sideways. We're still above the 20-period moving average on the daily side, and anything that's going sideways right now, that's positive if it continues to consolidate and go sideways. But we're also into that period of time where the last couple of years we had really solid up years, but it was right around the middle or so of July when we saw a pullback, and it was a little longer lasting in 2023. We started about halfway through July. It lasted till the end of October. It didn't go straight down. We had a few bumps going back up along the way. It did go down quicker in 2024, but it was down about 10%. Right when we got near that 10% correction level, that's when the smart money started to come in. Now, we don't know if things are going to play out that way this time. We have a different administration, the economy's in a different place, earnings are in a different place, but to kind of just be aware in case something like this happens. And it's common, at least over the last few years, to see some kind of a downward move in July. And we're looking kind of overextended with some of our charts here. So let's go back over the last week's session. For the week, we were up 0.59%. We are below average with volume. Now, even Friday was options expiration, and we were just average with volume there. And this is pretty typical of the summer months, unless some really big things are happening. And people are on vacation, they're doing different things, and just getting away from the market for a while. We are still positive, but there's some cracks that we want to be aware of here. Inflation, we had CPI come out, it was stronger than expected. Then we had PPI come out that was weaker than expected. So I guess on average, we're just kind of maintaining the status quo there. But CPI is what the market really pays most attention to. Interest rates, we're still below that 4.5% level with the 10-year yield. When we get up close to that, that's when you can kind of see a little bit of pressure coming into stocks. And of course, we have geopolitical things going on. Israel, Iran, Russia, Ukraine are the big ones. And then anything domestically that may develop that would have an impact on the overall markets. And we do have a speech upcoming this week from Jerome Powell. That'll be on Tuesday. There's no economic reports coming out that day, but he's giving a speech. His stance lately has been wait and see, wait and see. I always thought that'd be a really good name for a boat. But anyway, we'll just see, we'll wait and see what he has to say, and if it's more wait and see. And the market is not anticipating that we're going to go into a recession right now. And that's what we pay attention to, is the market, not what we hear on the financial media or any kind of media or YouTube videos or what have you, because you can predict anything. It's just, what does the market think is actually going on right now? We are still in a weakening trend. It's hanging on to being positive right now, but the ADX is coming down below its moving average. We're not quite in a trendless environment yet, but it is a weakening trend that is positive. Okay, so we were down 0.1% with the Dow. The NASDAQ was up 1.5%. Now we're dealing with earnings season, and there's only 30 stocks in the Dow, and so you get one or two that the Dow doesn't really handle all that well, or the market doesn't. That can really have an impact on the Dow, where it's more diversified if you look at the S&P. So we were up 0.6% with the S&P, and we were up 0.2% with the small caps. Okay, now it's a little bit smaller here. Had some more things that I wanted to cover this time. It says the stock market posted modest gains despite volatility from earnings. And this is what's interesting and why I don't do earnings plays, as they call them. Because you can come out with just a stellar earnings report and the stock sells off. You can come out with a terrible earnings report, like one recently was Tesla, and it went up. Well, there's this buy the rumor, sell the news kind of an idea where stocks have a tendency to go up or front run the earnings. And then once the earnings come out, the people do the opposite. If they were selling, then they buy. If they buy, then they sell. And of course, the economic data, we're hanging in there for the most part right now with the economy. Fed policy speculation, there's really not much. The market is pretty much convinced. People can say whatever they want. Even people on the FOMC committee can make speeches and say whatever they want. The market's pretty much locked in that at the July meeting later this month, the Fed's not going to do anything. And I'll show you that chart coming up. And then tariff developments, where now I think a lot of folks are finally learning that when President Trump makes these outlandish statements, it's like it's a negotiating tool. It's to freak the other side out. It's to bring them to the table and then say, okay, well, maybe we won't be as drastic by the time we actually work out a deal. And go back and read Art of the Deal if you want to see into his way of negotiating. And then the NASDAQ, S&P did close at or near all-time highs. And while small caps, they did have a pretty good week, but I wouldn't necessarily consider them outperforming right now. Earnings season is really getting up and going. We still don't have all that many stocks in the S&P that have reported, but it usually starts with the banks. We had JP Morgan, Citigroup, Goldman Sachs, and then Citibank stood out while others saw sell the news pullbacks, as I mentioned earlier. Taiwan Semiconductor lifted chip stocks. Semis are hanging in there pretty good. And a positive outlook. Snap-on, Pepsi, Travelers also beat expectations. But then Netflix, which is just coming off of setting a series of all-time highs. 3M, American Express, they saw selling, even though they've been doing quite well as far as their earnings are doing. And then tempering overall sentiment, while regional banks, Comerica and Regions outperformed. Okay, then economic data. I usually don't go into it that much here. I go through it more in the daily video, but I wanted to include kind of a bigger picture look where I said CPI was better than expected. Then we had PPI, which was weaker than expected. And then retail sales. It had been down the last couple of months. It was up in the latest report. And then this just shows more strength with the consumer. Jobless claims are kind of falling back down into the range that they've been in for quite some time. We're still keeping an eye on the continuing claims, and they're still under 2 million. We're at 1.9 million and change there. So that shows that the labor market is still looking pretty solid. Housing starts, at least in building permits, the numbers that came out were really good. But then when you looked under the surface, it's like, well, they're not building a lot of single unit homes, and the building permits don't look as strong after all, because we set that intraday all-time high right at the open in Friday's session, and then we ended up going down after that. Not declining in a big way, but we set the high right at the open. Consumer sentiment did come up a little bit, so there's a little bit more optimism there. And it's showing a resilient economy with sticky, which means that inflation is just not coming down. It's sticking in one place, though moderating just enough to keep the Fed on hold for now. And that's pretty much what the market has been going with. And then several Fed officials like Collins, Williams, Kugler, again, if you saw pictures of them, you probably wouldn't know who they are. They say that the current policy is appropriate given the ongoing inflation risks. They're still worried that these tariffs are going to come in. And a lot of people are too, and that's what we're watching for. Everybody has an opinion. So far, the tariffs haven't been that big of a deal, and it's actually given the government a net. They brought in more money than what was going out, and a lot of that money was coming from the tariffs. Let's see. And then, of course, there's this, not only is Trump having his little spat with Elon Musk these days, he's also not getting along all that well with Powell. This caused some disturbance where Trump came out and said, well, maybe I'll fire him. Well, first of all, he can't unless he has probable cause. And there was some speculation that, well, the Fed's been doing all these renovations over there, but yet they're preaching about how we have too much debt. And We need to really be more careful with things. So Trump was going to try to get him on that. Then a little while later, says, well, that's highly unlikely. And then that pushed the market back up. Okay, so there's a lot of craziness going on around that. Then tariffs and trade tensions. Earlier in the week, Trump proposed a 30% tariff on the EU and Mexican goods effective August 1st, and he had reassurances from the EU and the Mexican leaders to help stabilize the markets. All right, then they announced a second round of tariffs on Russian goods. It's like, okay, either the war ends or you come to a ceasefire by September 1st, or we're going to slap some tariffs on you guys. The markets largely shrugged this off, but remained alert to inflation risks from rising import costs. We're not really seeing that, at least yet. And then tariffs remain a real wild card for both inflation and monetary policy going forward. That's why when Chair Powell comes out, he's like, we have to wait and see, because I don't really know what's going on here. Market performance and flows, the S&P, NASDAQ, and NASDAQ 100 set multiple record highs throughout the week. And then we're at 4.43% with the 10-year yield. We did tick up just one. We were at 4.42 a week ago. The dollar is bouncing, but it might be from more of being oversold, but it can't seem to get back above its 50-day moving average. And then resilient economic data and strong earnings kept the equity markets buoyant. That's why we're holding up for right now. There's all this doom and gloom that a lot of people were predicting, which may still end up happening, but it hasn't happened up to right now. And then what's the Fed going to do? Tariffs. There's a lot of open-ended questions right now. And then we have the July meeting coming up on July 30th with the Fed. Investors should expect continued headline-driven volatility. So yeah, if something comes out of the White House or something geopolitical happens or something that the market doesn't like or does like, that could actually add to the reaction. Okay, and I show this every week, and you're probably getting tired of that for those of you that consistently watch the videos. But we are still, for the most part, still in this dark blue line area with inflation coming down. The reason I show this chart is just to suggest that just because things are this way now and have been now for the last few years, it doesn't mean they're always going to stay that way. And we saw that back in the mid to late 70s where we had stagflation, with inflation really going up, but no economic growth at that time. We're at 4.43%. This is also what's tugging down some of the earnings, not making them as robust as they were as far as their projections in the past. This has not been updated. It only gets updated when the employment report comes out. Same thing with this chart. Then here, and this is something that we see all the time. I also go through this a little more in depth with the intermarket analysis video update with the NASDAQ 100 coming in at 29. We still use that 10, 15, 20 scale, and we're at 29. So yeah, we're overvalued there. And then again, I don't see this. I look at the S&P 600, which is the other small cap index. It has us between 14, 15, and 16. This one is at 24, where the S&P is at 22. Expensive there. The equal weight is more fairly priced at 17 with the mid caps, which have really been underperforming, right around the 16 level. Then Goldman Sachs Economics predicts U.S. tariff rates to rise. Okay, you can say 150%, down 30%, whatever projection you want to come up with, but they are expecting things to actually go up. And at least Goldman Sachs thinks they'll get to 19%. Who knows what's really going to happen? Nobody was alive at the time when the U.S. government, that was the main way that they were getting their money, their income was from tariffs. But that was so long ago, the total economy has switched since that time. All right, and then this is kind of a contradiction here, where we still see analyst projections going up. Well, let's see. We've actually been seeing them coming down as far as what's really been happening. So a little bit of a disconnect there. And then foreign markets provide 13% of U.S. corporate profits, emerging markets 4%. So just showing how much of these companies that do business outside of the U.S., how much of their profits come from foreign markets and emerging markets. Okay, then we did get some housing data in Friday's session, and we are seeing this going down, and that's a bit of a concern. But we don't necessarily see this really falling off. It does decline when we do go into a recession, but it's kind of going a little bit slower right now. If it really starts to decline, that would be another warning sign that maybe we are in fact going to go into a recession. Longer term view of IPOs, these are initial public offerings, not as high as they were before. And this typically happens in a more positive market environment. When we're really going up, new stocks that come onto the market, they go from private to public companies. They're usually able to get the highest dollar for that. And that's what they want. And that's when they're taking their stock public at that point. And the run of inflation misses is historic. This could give the administration confidence. Okay. So we're just seeing that the projections and the forecasts that were showing that inflation was really going to go up, and actually it's still continuing to go down. All right, and FactSet, they're kind of really busy these days. This is when they get really active with their earnings. So far, according to this, S&P 500 companies are likely to report earnings growth above 9%, which is really, really good. My goodness, to see these companies having that. Now, it's not as high as 12 or 15%, but it's still very respectable nonetheless. And this is the update. Only 12% of S&P 500 companies have reported so far. Of these, 83% have been above their estimates. So that's still looking good. Now, they tend to lowball these a little bit here because they come out and say, well, this is what we think our earnings are going to be. And then the report comes out and it beats expectations. And then that's why we see them go down, because a lot of people know that game and they front run this and then sell once the report comes out. Here's the daily chart. And we were kind of not really showing a lot of conviction. We did see a downward move here on Wednesday. This is when, oh, I'm going to fire Chairperson Powell. Oh, wait a minute. It's very unlikely. That was kind of the big move that we saw during that time. But if you go about halfway through Wednesday and then carrying it over into Thursday, it was looking like, okay, now we're starting to build some momentum here. The only problem is we gapped up, set the all-time intraday high here, and then just kind of came back down and went sideways after that in Friday's session. So going just on the week, the 5 trading days, all of the indexes did okay here, with the NASDAQ and NASDAQ 100 and S&P being positive. And then the NYSE, which has been holding up better, it was negative. The Dow was down, mid caps were down during the 5 trading days, and the small caps being down the most. Year to date, all of the indexes are positive except for the small caps. They still have a ways to go to get back. The sectors, since we had an up week, tech ended up doing the best. Utilities are making a bit of a comeback. Industrials are doing okay. The financial sector hanging in there fairly well. If you watch the daily videos, what I've been really trying to highlight there is we look at a ratio between the financial sector and the S&P. It had held up above its 200-day moving average with that ratio. Now we're below it. Now we bounced up a little bit, but breaking below that, that just shows that the financial sector lately has been weaker than the general market itself. And then energy still ended up being down, as did materials, which have been on a really good run lately. So there might be some profit taking there. Then looking at the scooter score over on the right-hand side, we still have tech coming in at 90. That's the strongest part of the market right now. And we have industrials and communication in distant third here. So we're still looking at industrials and tech leading the pack higher. The weakest areas are healthcare and energy. Again, I don't know if they can go negative here, but that's about as close as you can get. Yeah, looking at just the sectors for the 5 trading days, we had tech and utilities were up. All of the other sectors ended up being down during the week. Going back to the beginning of the year, we're still seeing industrials doing quite well, tech and utilities, communication, and then financials, with materials just kind of hanging on the edge. Healthcare, discretionary has been improving, but it has a lot of damage still left to recoup. Then here is the market carpet for the whole week. And when we see lots of green in these big boxes, that's positive. And this is tech, where we had a little bit of a mixed picture here with communication, another growth area. Then discretionary, Amazon was up a bit, but Tesla bounced up. It's finally getting above its daily moving averages, but it's not quite in an uptrend, at least yet. All right, and then we look at the relative rotation graph. We see technology coming on. This goes back over the last year. So this is a growth area, and this doing well is what we want to see when we're more positive. The industrials have been doing well. They're still green, but now they're starting to turn down. Communication has been languishing a little bit here. And then we're seeing discretionary improving. That's also another growth area. And then the areas that are red and going down, they tend to be more defensive for the most part. So we have industrials and tech looking pretty good. Communication is more neutral. Then you have the negative areas here with discretionary showing some improvement. Looking at the different indexes, NASDAQ 100, that's growth, setting all-time highs a few times through the past week here. Also, we're seeing the S&P 100, the biggest stocks that make up the S&P 500, that's coming on. The S&P not showing an awful lot of strength, but just coming off of recent all-time highs itself. And it's because it's more balanced between growth and value. Well, we are seeing an improvement here with the transports and the small caps, but they've got a long ways to go to make that up. Where what we're seeing really showing some weakness now are utilities. That had been a stronger area, and now that's starting to underperform. So the S&P 100, NASDAQ 100 looking positive. The S&P more or less neutral at this point, with the mid caps, composite, and utilities being more negative. The transports and small caps are improving. Sentiment. Now, we're not really extreme here. This is the latest reading from Investors Intelligence. These are folks that have newsletters and websites and actually make recommendations to people. They're positive since we're above 2, but we get concerned if we start to go above 3. That means they're extreme positive. But we are extreme positive here, and we've been this way. We're still coming in at 75, and we don't see this very often. How we camp down below 25 here through a lot of March and into April. My goodness. Now we're camping right around the 75 level. Usually we come up, we hit it, and then we tend to back down from that. So far, this sentiment has held up, but we've been keeping an eye on this. A little bit of a downward move here with the active asset managers. They had become extreme positive. Now we're seeing that pulling back. This is the latest reading at 83.69. It did decline from the previous week. We're still below 20 with the VIX, both with the line chart, even though we were flat overall when you measure it from week to week. And we're still staying below 20 here, even with the bar chart. That's the open, high, low, and close for the week. This is still positive. Cash to the tech sector still going down. That means the tech sector is outperforming. And we saw a bit of a bump up here. Folks are starting to freak out here with the RIDEX bear bull ratio. When this goes up, they're getting more bearish. When this gets really low, they're more bullish. But there's a day lag here. This just goes through Thursday. It doesn't count for Friday. And still looking just a little bit positive. We're right about at the tipping point here, 0.3 now with individual investors. And then this is a little different way to look at this. I got this from Edward Yardeni's site here, where he has an average here with the bull-bear ratios. This is from Investors Intelligence. We're coming right back up to what the average has been, 2.57. We're right about there now, according to this chart. And then we look at the bear-bull ratio with the individual investors, the chart I just showed. We actually went above the average, and now we're dropping a little bit down below it. All right, the Ulster Index still showing that there's not a lot of fear in the market. We're not really seeing any problems here with the spread between risky bonds and not as risky bonds, like junk bonds and government bonds. So we're a little bit showing a little increase in fear here, but it did come down in Friday's session. But we're not really seeing anything too crazy, at least for right now. We're continuing to go down with the VIX, and then the 3-month average of the VIX and doing a ratio between the two, that's still positive. We continue to go down with the very long-term equity put-call ratio chart. That's positive. The economy still seems to be kind of humming along here, not really showing any big changes. We're still below the black line with the Chicago National Financial Conditions Index. That's positive. Coming in at about 2.5% with the latest reading from GDP Now. That sure beats the negative GDP that was coming out last time. So this was the negative GDP here. If we can still stay positive with these forecasts, because we have to be negative for 2 consecutive quarters for that to be part of a recession. But we're not seeing other areas of the economy showing many recessionary signs right now. This is the New York Fed staff nowcast. They're actually coming in a little bit lower at 1.7 for their latest reading. This was not updated. It won't be updated until the next employment report comes out, but this is looking more positive. We're still below the black line with the smooth US recession probabilities. This won't be updated really until the end of the quarter, but this going down is more positive for the market. Inflation, since we're still starting out with the new quarter here, we did see inflation start to tick up a little bit. And then as CPI came out this past week, these did adjust, but we're not seeing any big changes here. And then this is what I'm talking about, 95.9% chance that the Fed's not going to change rates at their meeting on July 30th. There's still 4% out there thinking, yeah, we're going to see rate cuts, but no, it's about as close to certain as you can get. Now, there's still a little bit of time between now and July 30th, and anything can happen. So we just look at this as probabilities. And the market's pretty much been convinced of that and becoming even more convinced that there's not going to be a rate cut. Now, we're a little more split when we look out into the middle of September, where it's 50, a little over 50%, a little over 47%, thinking that we're going to be the same, with a little over 50% thinking that we're going to have a rate cut. There's even the Fed has said they're still looking at doing 2 rate cuts between now and the end of the year. They think now that maybe if they do the first one, it will likely be in September. And the market's a little bit more convinced of the rate cut than not being convinced lately. And still coming down with the Fed balance sheet. Like to look at that once a week. This is where we topped out in June of 2022 when inflation was really high. And the Fed said, we're not going to do quantitative easing, meaning buying assets. Now we're going to start to let them fall off our balance sheet. And that's pretty much what's been happening. The little blip up here, this was during the little banking crisis that we had back in 2023. And we're still tending to go up overall, though, when we look at the year-over-year change with the Fed balance sheet. Not really seeing anything crazy here as it applies to the banks with the overnight reverse repurchase agreements. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. So now, looking at our charts, looking at the advanced decline line studies, we're looking pretty good here, setting all-time highs based on volume, really near all-time highs based on price. Now, this is a weekly chart, so it moves a little bit slower. And we're rolling over a little bit here with the new highs minus the new lows. We're going down with the 4-week and the 10-week. We're also declining on the daily side as well. And it's not that we're seeing more of an expansion of new lows. It's more of a contraction of the new highs. So they are coming down a bit. Still positive here with our short and intermediate term advanced decline ratio. As far as our trend, we continue to go down below the moving average, but the green line is above the red line. So we're positive. Now, if we drop down below 20, that means we're in a non-trending environment. So we'll be keeping an eye on that one there. We are positive with the Arun. When we're above 0 here with the oscillator, that means there's more buyers than sellers. And we're still looking at this, the mass index. It has triggered a signal. All of the criteria has been met. We were going up for these lines to do what they were doing. So we're still thinking that this could suggest a reversal will happen. But as of right now, we really don't have any evidence of that other than a tired-looking market that's over-exuberant. Okay, here's the daily chart. Still looking pretty good as far as our basic overall pattern with the new highs, new lows. We have slowed down a little bit here. And then we continue to be below average pretty much every day with volume. Still looking good here with our 50-week moving average. Prices above that. Everything is still going up. Then we use a moving average crossover here. The blue is still above the red, and we're just coming off of recent all-time highs. Still looking good here. We might hit some overhead resistance if we hit the upper end of this trend line, but we're not quite there yet. And I show this in the daily videos. We're still looking good on a weekly basis, seeing a period of higher highs and higher lows, and we were up on the week. Now, looking at our smart money indicators, accumulation distribution, we're positive here. We're above an advancing moving average. We're showing a little bit of weakness here, possibly getting extreme when we look at the boom indicator, which this is more short term. to measure it tries to measure the interaction between the indicator and the moving average itself. Positive with the Chaikin money flow, and we're positive and starting to get extreme with the Chaikin oscillator. And this is really kind of positive here. The vortex, we're way above the red line here. We're positive, but this is something just to be aware of. We're extreme positive with the green line, and we're extreme negative with the red line. Now, you can see other times we can even go more than where we're at right now. And we're slightly below zero with the S&P weekly McClellan oscillator. And then the bullish percent index, we're negative on the daily side because we're dropping down and we're below the moving average, seeing pretty much that same thing here. And we're still above zero with the summation index based on price and volume, even though they are declining slightly. And we're dropping a little bit below zero with the swing trading oscillator based on price. We're declining, but still above zero based on volume. Momentum is still looking good, though. The PMO's positive. We're above zero based on price and volume. But we are coming down a little bit below 50 with the PMOs that are rising. Also dropping below 50 with the buy signals and starting to come down, but giving us still a pretty high reading with the PMOs above zero. And still above the midpoint here with the percent B. We didn't close outside of the upper Bollinger Band, so that didn't trigger there. So looking at our momentum, we're positive across all the time frames here. We're actually starting to see some weakness and turning more negative on the daily side. And we're negative on the daily side with the Copic curve, where we continue to be positive here on the weekly side. And just kind of going sideways after being extreme with the money flow, but this is still positive. The force index, it's still positive there since we're green. Looking pretty good from a momentum standpoint with the Stochk RSI. The Williams percent R is also showing good momentum. And we're still above 50 with the RSI based on 14 weeks. And just barely extreme positive here with the ultimate oscillator. But these are all still looking positive, but maybe a little too positive. We had a slight up week here, so that's why we saw the upward move with that. And we're going a little bit further above this red line here when we go back 50 weeks. Now, we get a little bit more concerned if we get above the red line, but sometimes we get up to this red line, and that's showing some more intermediate term exhaustion. We're positive with the Special K weekly chart. We continue to be negative with the Special K daily chart. And I haven't adjusted this yet because we haven't really seen much of a downward move here. Once we do set some kind of a high and possibly retrace, then I'll adjust these Fibonacci levels here. So we're still looking good on a trending basis with the Heikin Ashi. We're still black and pointing up with the Kegi chart. That's positive. We're still positive with the Renko chart, and we're positive with the three-line break chart. And didn't see enough movement here to draw in any X's or O's for the week, but we're still doing this breakout that happened at the beginning of June as we're getting really close to all-time highs. And we're positive again here with the ease of movement above zero and continuing to advance and looking pretty strong there. We're on the daily side, we're just hovering slightly above zero. So the long-term trend, we're still looking pretty good. We're starting to level out, but still positive in the intermediate term. Seeing a little bit of weakness here with the short term, but it's still positive as well. We've gone from positive to neutral with the Elder's Impulse system for the S&P, but we're still positive with the Parabolic SAR. We had something interesting happen on the daily side. It was negative for one day and then switched back to being positive. You don't see that very often. Usually once a dot gets going here, it tends to stay with those dots for a while. Broad market, positive across the board on all different indexes here. Still negative across the board with bonds based on price. The dollar is rebounding a little bit, and we have commodities which are strong, which may introduce some more inflationary concerns. And why is this here? I already went through this. And this isn't even for this week. I don't know why this... I take this chart out and it kind of magically reappears here for some reason. So just coming off of recent all-time highs here with the S&P, still having a ways to go with the mid caps and the small caps. Then looking at some other indexes here. NASDAQ weekly chart just setting all-time highs here in an uptrend. Also just starting to form a new uptrend here with the Dow. NASDAQ 100 coming off of recent all-time highs and in an uptrend. Mid caps still a ways to go here. Not really breaking out, but not breaking down either. And the small caps even have a little bit further to go to get back to an uptrend and not really performing all that well. where we're just coming off of recent all-time highs here with the NYSE, and it's in an uptrend. Daily chart of the Wilshire, just coming off of recent all-time highs. The FANG index, also recent all-time highs here, looking pretty solid. These are the really big stocks. All stocks, U.S. and international stocks, still looking pretty solid here. ARK is in an uptrend as well. And then the banks actually came off of the low that was set here, looking pretty good with the RSI. We're also still positive here with the MACD. And then July has been positive every year, every year going back to 2021. So this has been a pretty positive time. That's kind of why I'm focusing more on what happened in 2023 and 2024. We're going to see if we see some kind of a repeat with that in 2025. All right, then here is the Dow, not as close back to all-time highs. Still seeing some improvements here with the transports and still tending to drift higher here with the utilities, and they had a pretty good week. Broad market here with the CRB index in an uptrend above both moving averages. Still up into the mid to upper 60s here with oil. Still in a downtrend with the dollar. We just about got up to the 50-day moving average, and that could be acting as overhead resistance on the daily side. But both the daily chart and weekly chart here are in downtrends. But copper setting all-time highs here, at least all-time highs on this chart, going back to 1980. That bodes well for the economy. Gold just kind of chopping along, going sideways, a little bit above its 50-day moving average. Silver was actually down on the week, but it was starting to break out where gold was going sideways. Then looking at the price of bonds, still looking pretty good here in an uptrend. Monthly chart so far, we're still continuing to go up, showing stocks are outperforming bonds. And here are the yields that they were starting to go back up, but then they dropped over the last couple of sessions. Then we're keeping an eye on the red line here. This is Japan, just to see if that's going to produce some kind of a problem. It was a year ago, August, that we had the end of the world day. That all started in Japan. And if interest rates really start to break to the upside, we just want to watch for that and see if it leads to a global end of the world that lasted a couple of days type of scenario. Then we still have gold, best performing asset in 2025, followed by stocks, then commodities, then oil, then bonds based on price are actually negative now year to date, and the dollar is still having some problems. Then the ratio between the NASDAQ 100 and S&P 500 shows the NASDAQ is outperforming. Also outperforming with the S&P 100 when we do a ratio with the S&P 500. Growth is still outperforming value. And gold is kind of going sideways. And we're seeing this ratio coming down as stocks have been doing better lately. And just kind of chopping along here, but still the dollar's been under pressure. Gold's been going up. That's why we see this ratio going up. Bonds continue to underperform stocks longer term on the weekly chart here. And this ratio going down is more positive. This shows that the low volatility stocks are underperforming the S&P. And we're seeing a recent death cross with this ratio. That's more positive. Discretionary really improving, starting to see an uptrend here when we do a ratio with staples. Energy continuing to underperform tech. That's more positive for the market since tech is growth. And small caps continue to underperform the tech sector. Then looking at some longer term charts, not really getting anything all that much with the NYC breadth thrust. I was pointing this out a while back, but a lot of time has now passed. We were getting extreme here with the ZWAG NYC breadth thrust. That's not a signal. We were just above this red line, which means that it's an extreme reading. We didn't have an extreme negative reading, which is what the signal really is. But this is about the time when things started to slow down, at least for stocks. And we're on a full-on sell signal with the Zohar-Check method. And I've been showing this chart in the daily videos as well. That is longer-term negative. But when we look at this, going back to the 1987 crash, S&P is looking pretty good there. This is that same trend line. We're still well above that. And the NASDAQ weekly chart, we're still dealing with this long-term trend line going back to 2009. About the time we hit this is when we started to slow down, but we're still setting new all-time highs. They're not massive new all-time highs, but if we set an all-time high in any kind of an up day, that creates another new all-time high. All right, then looking at the S&P longer term with the highs and lows, this is continuing to go up. That's positive, and we're above zero and going up with the NYSE new highs, new lows, 50-week moving or 50-day moving average. This ratio is still looking good. Growth versus value is still going up here. We're also looking good above the blue line when we look at the Qs to the small caps, and still going sideways with the 3-month yield. Not really seeing any changes there. Still trying to go up the cumulative new highs, new lows for the NASDAQ. That's more positive. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then seasonality. We're done with the first half of July, which is the best half month going back to 1950. Now, the second half of July does do okay, but it really underperforms the first half. And then looking at July itself, going back to 1964, that's when Beatlemania hit, We're up 53% of the time with a return of 0.8%. Then we look at June through November with a return of 3.4%, up a little more than 2/3 of the time there. Then post-election years have been pretty strong, so we're in a post-election year still right now. And this is the Carson chart where we're going through this kind of little sluggish time. But if we can go through this and still set new all-time highs, that really shows some good things for the market overall. For July, the S&P, this is the best month where it's up 12 out of 18 times, down 6 out of 18 times. And then no matter how, I say this, no matter how you slice and dice it, you go back to 1950, the past 20 years, the past 10 years, during a post-election year, everything is positive for July. This is a composite here where we're in a post-election year where typically now is when we see some kind of a downward move. But that's just what has happened in the past. We'll see if something like that ends up happening in the future. And then this is also from Stock Traders Almanac, just showing lackluster June into July. And then we see a little bit more weakness as we go into August and September. Then this just shows how the volume really tapers off in July and August on the NYSE as well as the NASDAQ. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.